It sounds insane. It's insane, right? The S&P 500 hitting 10,000. Crazy. But what if I told you it's not just possible, it's inevitable? In today's video, we're breaking down the exact factors that would push the market to that historic number first, faster than anyone expects. From tech dominance to global economic shifts to AI, to energy, war, and everything else, see why 10,000 S&P 500 is actually closer than you think. Let me share my screen here. All right. So what I'm doing right now, hi, I'm Chris, founder of PaulandATraining.com. uh, I'm doing some research, and I'm putting together all my research over at PaulandATraining.com. Go over there, PaulandATraining.com, sign up, free email. It doesn't cost anything. I put together research like this and other type of statistical knowledge about and data about markets. So PaulandATraining.com, it's free. Like and subscribe to the channel too if you like it. So what we're talking about here is the S&P 500, which is currently at 5842 as of this very second, achieving the $10,000 mark. I was interviewed this morning on Face Analytics, and they just asked, what's your target, Chris? And the thing is I just overwhelmingly believe and know, because I'm looking at how this stuff works, that 10,000 is inevitable. 10,000 S&P 500 is inevitable. 40,000 NASDAQ's inevitable. Probably 50,000 S&P 500's inevitable. 100,000 Dow. All of those are inevitable, given what we're going to go over here. Okay. I'm not saying that we're going to wake up tomorrow morning and it's 10,000 S&P. In fact, just using the regular metrics of a 12% compounded annual growth rate for the S&P 500, that should be there but in 4.5 years. Simple math. It doesn't require a lot. Now, in order for 4.5 years to actually be the case, there's a number of things that have to happen and some things that shouldn't happen. And we're going to go and take a look. Okay. So I'm not saying that 4.5 years from now, we will be at 10,000. It might be sooner. It might be much later. And I'm going to go over how we can see, if that timeline is a little shortened or is extended for 15 more years or so. So we'll work on that. We'll get through that. This is my live process of as I'm working through some of my research. I wanted to go live on this one because, gosh, it's a fun subject. And why not? We're trying stuff out here on the channel. Again, like and subscribe. I'm doing this best I can, trying to grow, do more of these sort of things if you like them. So I'm putting this out here so that I get feedback. Okay. The typical feedback here, and by the way, this has been me. This is, so many people, is the midwit, the middle curve response. So on the left-hand side of the curve, you have, hey, the market's going up, smooth brain guy. On the far right side, you've got the Jedi Master who's like, yep, market's going up. I can see the chart. It's been doing it forever. It's going to go. And then in the middle, you've got, but war, but the recession, and we've never lowered rates and rising and not had a recession, and we've got global liquidity issues and an election and all the millions of things of why it wouldn't happen. And honestly, usually those, because everybody knows them, those are reasons why they do happen, because people are constantly underpositioned for, a good outcome, and overpositioned for a correction. Now, I'm not talking about your parents or your friends' 401ks and IRAs. Those are the far left curve folks. Just every month putting their money in, going to work, doing their stuff. They're not paying so much. Yeah, they pay attention to the news, but they don't do anything to their account. They don't go and buy puts. They don't go and short Bitcoin at 67,000 trying to be right. They're just kind of mid curving it or left curving it, smooth braining it. The people in the middle are the loudest ones. They're the ones who are most loud. And let's just all look at ourselves in the mirror for a second and say, we all fall into this area. They're the loudest, the most confident, and usually the most wrong on these sort of things. Okay. So let me set it off like this. This is the S&P 500 on our screen here. Currently, like I said, 5842 on the S&P 500 index, cash index. Okay. This goes back all the way to 1871. But where it becomes, where we're going to start our story is the end of World War II. Yep. I should have everybody's attention right now who is a dude. History, World War II. Oh, let's go. Let's bring in some Roman Empire in here too, right? So I'm going to start it there, and we're going to go back even further, but we're going to start here with coming back from or coming out of World War II. The United States, which represents the S&P 500 here, was the only, and it was an emerging superpower, the only superpower of any capability at that point in time. Europe had just been wiped out to ashes. Any superpower in Europe was crippled, was incapable of anything other than rebuilding their society. Sure, there was, the great Portuguese and Spanish and Dutch civilizations that were former superpowers, were the dominant superpower in the world, but they were a shell of themselves. And Spain had just got out of its own civil war. They were like, look, we're not even going to get into this whole World War II thing. We just went through, the worst we've ever, had. Russia, Soviet Union, was they won because they were part of the Allies somewhat. They won coming out of World War II, but it was like the best loser. They lost like 1 million folks. Their society was like hammered. They had dictator in charge, and it was just it was a tough thing. And then we look over to Asia, and you had Japan and China at war. Japan was just burnt to the ground, fire bombings, and we were bombing them so bad that the only human, like it was so bad that if we kept firebombing, we were just it was gonna be so inefficient, and we're gonna destroy. Like we couldn't get Japan to surrender. They're just not built to do that. They weren't built to do that until we did the nuclear bombs, and that got the final out. So I'm not going to get into the humanity of that, but they were like ashes. China was a backwater back then. It was in its whatever 100 years or 1,000-year disgrace or whatever. I forget what it's called. And then of course they were also fighting Russia on Russia's eastern front, Japan's western front. So there is like the big superpowers of the world were just in ashes. Yes, Australia and South America and Africa and these Asian South Asian type, smaller country or big, India, whatever, like they were not superpowers. And they may or may not have been affected so much by World War II, kind of like the United States on land was not, our homeland was not affected by World War II. But they weren't big enough to really affect anything. The United States was the only country that didn't have to rebuild its entire infrastructure, society, everything. We just went off to war and we came back. we had a huge manufacturing base built because of the World War, in order to, get back in the game after our ships got destroyed. And we were lending all of everybody was needed to be us to be a creditor. And so the United States had the Bretton Woods. And I'm kind of just like painting a broad view here, not the details, not all the things, but bottom line, it worked out that the United States was best to be the global reserve currency because we were backed by gold too. So everybody, you looked at it like, well, if nothing else, I can call my notes and I can get my gold back. But the idea was that everything would be traded in dollars because we were writing checks to everybody and rebuilding the world and all those sort of things, that it would be, it would be us to do it. And that put us in that superpower mode. Now, the thing is a lot of people think that you came back from World War II and it was just straight up, send it mode. And there was about 5 years of actual, so your country had been all 90% of military age males were at war, dying, fighting. And the remaining 10% of men here were either not capable or in a role that was needed to be home to support the war effort. Like you were a key, I don't know, cop maybe, or you had some technical skill set that was necessary for manufacturing. And so they needed you here to manufacture things to get it to the war. Right. And then, of course, the huge amount of women who stepped up and moved into those roles. Now, this whole cohort of folks were raised, they're rugged lads. They were raised through the Great Depression, where they didn't understand that a full belly was something that you could have. It was a tough time. They got through it together. And then they go into World War II and they go through World War II fighting with their comrades in arms, right? Your team. You follow a strict rule set. You do all these things. You're part of a team. You're part of a community. And so communism was kind of a thing that was, kind of on the agenda here in the United States going into World War II. And as they came back, these gentlemen come back to the economy's okay. We're done with war, so we don't need any more manufacturing. Okay, so we got all this manufacturing. There is a sense of loneliness because you don't have your team anymore, and now of course you're making a family. But it was a tough time for about 5 years. There was a Marlon Brando movie, Rebel Without a Cause, was based on this, and this were motorcycle gangs in the United States were founded. And then we start the rebuilding Europe and Japan and all that, and General Eisenhower sees well, first off, we have the GI Bill. So you go to war, you come back, and you get money from the government to go to school, learn a trade, or go to university, get a degree. Back then, go to university to get a degree was kind of a trade. Now it's just go to get a degree. Don't learn what you need to do your job, but blah blah blah. Unless there's certain jobs, right? So General Eisenhower, doing the reconstruction of Europe, was see the highways in Germany, the efficiency and all how great they were. And he's like, well, we need to do that. And at this time, we had the baby boom, we had automobiles, we had electricity, we had, running water, we had a lot of infrastructure, but a lot of the country was still centered around the cities. And so that money the government started saying, you know what, let's build these highways. Let's build this national infrastructure so that we can, take advantage of the this vast land we have. And so it became an economic machine where you build roads so that people could drive on the roads to another destination, and a natural distance would be like a tank of gas where a new city would start to form, because you would have a gas station, you would have a restaurant, you would have a motel, and then people to support that. And then it just kind of grows. And so when you have a car, you don't need to live in a big high rise in the middle of the city. You can start moving out to the suburbs. Back east, you can see, like in New York, you can see the suburb, the Long Islands, and those sort of things, right? In Chicago, you can see the downtown. Downtown was the big thing, but it starts pushing out once you get cars and a lot of that infrastructure being built out. So it continues to push out west, and this means, okay, we need to hire people to build roads. Those people need to build, buy supplies, get trucks, hire people, transport, do the work, eat. It's this supply, this redundant supply chain that kind of feeds itself. And they're taxed. Tax dollars come in. They, that whole sustained economics model works great during that period of time. At the same time, we're doing a lot of reconstruction in Europe. So we take in the United States, take our entire manufacturing base, and we start just going to work on construction of buildings, of cars and refrigerators, and the expansion to places that are harder to settle for a lot of people. I live in Arizona, Phoenix, Arizona area, and it's a Wild West town. Like, it was settled in the Wild West. And you realize how rough it would have been, because it's 110, 120 degrees during the summer here. It's not wonderful. So it wasn't like a huge population, but there were some rugged folks that were out here. It was nicer in the mountains, but a mountain, you don't settle. It's too hard, right? So these big flat towns eventually started to kick up, because as you expand out, more people can get there. Now cars, now there's commerce there. Now there's a reason to be out there. There's a distance between, stops along the way. And, you start doing air conditioning. And then now, instead of these high rises, you take that high rise and you deconstruct it and you make it flat and you have a suburbs. So for 20 years, now I'm on to my point. For 20 years, the market, this was a secular bull market. Okay. I'll say it started from, because it did nothing from 46 to 50 or so, but you could say from the bottom in 1942 or so till 1968, 42 to 68. You could even say 50 to 68. It's your choice where you want to start the bull market. But that was anywhere from a 20, 25 year bull market. Now, I want to stop and I want to say, yes, absolutely, there were some dips along the way. We're referring to as a secular bull market. The term meaning that it's a longer term. So we had the Bay of Pigs, or the Cuban Missile Crisis here, right, in 1962. Okay, 63. We had somewhere right here. Yeah, we had JFK, the president of the United States, assassinated. We had in 66 through 66, there was so it goes up to 95 and down to 70, so 20, like another bear market, a bear market here. But you can draw a line and say, yes, there were some 20%, 30% pullback. There were some nasty pullbacks, 73 to 50, that was a pretty nasty one. There were some nasty pullbacks, but overall, this thing, for, there was no period of time that it didn't, 56 to 58, 2-year period, that it went sideways. So that, it was just, there were some periods where it went sideways, but it wasn't big. So you go 20, 25 years straight pump, And that would have been post Bretton Woods, when the US was the global reserve currency, still is the global reserve currency. And we were the bank. We were the piggy bank of the world. We had the gold. We stored the gold. You give us your gold. We will give you notes. And those notes could be callable for your gold at any period of time, right? So we kind of push. And then now countries like France is like, you know what? I want my gold back, because it's a better deal for them to have the gold than to be inflated, like just think about the inflation that this could have, would have been causing for a country like, France, who was rebuilding, and Germany and the UK, they were rebuilding from the war while we were just pumping. So they were like, you know what, let me have my hedge for inflation gold. I don't need your notes right now. And that came into a head, in 1970s. And in 1971, President Nixon took us off the gold standard. He basically said, look, doesn't matter if your gold's in here or not. It's the gold's not important. You've got a checkbook now. You can raise rates, lower rates. You can do all these things. You don't need the gold. The gold is not the thing. You've got the power of a central bank now. And we did that too. And so for 10 years, it's if you want to take a look, okay, look at this 20, 25-year period. It's straight up. Yes, there were down moves, right? That's a secular bull market for decades. This is definitely not a bull market. You had these micro bull markets, and then another crash, a bull market, whatever. It didn't fully become a bull market again until really, yes, you took off over here, and I would say like 1980. You could go into 1982 and say that's when the bull market began. Secular bull market began again. But it would be fair to say for at least 10 years, you had a sideways market where you had higher highs, you had lower lows, you had lower highs, you had higher lows, but you did not have new all-time highs for about you did have one pop in here in 1973 that was not replaced for another 7 years. And even then it lasted for a bit, came back, and then took off. So we have, as evidence for now, 20 plus years of a secular bull market, 10 years of like hyperinflation and a bear market and chaos. And all it did was go sideways. Okay. Yeah. It wasn't, 122, 50% plus sell-off was vicious, but we went from 7 to 8 to 108. And you go from 120 to 60. Like, there's a price to be paid when you expand in a bull market, right? You get too far and you have to pay the bill. And usually that bill is paid in sideways or down markets to go in kind of, well, we all know what happens at when things get frothy. When let's look at it in like 1999, the dot-com bubble, that was very frothy. We had companies that were dreaming of being profitable in 20 years that were getting huge valuations. Most of them didn't make it. One of them that actually made it, and this was the no-duh choice in 1999, 2000, that it was obviously going to make it. It was obviously going to be the thing worth investing that much in, was Cisco, which still has yet to reclaim its all-time high from the year 2000, I think. It survived. It was one of the only companies that was just a no-duh obvious, this thing will win. Of course, it's because everything was kind of built on Cisco. They had that bit of a moat, but how many other infrastructure companies were like Cisco that just died? I traded a bunch of them. We get into housing, right? You're looking at a 5-to-1 leverage on a home. That's what you get. You put down 20% of the value of the home, and they give you a home to live in. So you're trading on 5x leverage in real estate. That's just basic. I'm not even talking like the stuff that they do, the trickery. You'd be able to get 10, 20 to 1 leverage in a lot of homes, 100 to 1 leverage. Some places there's nothing down and you get access to the whole thing and instant, like it's like my VA benefits. I could do that. And so what happened, you get into a nice real estate bubble. Everybody understands real estate because you live in real estate. You've seen your parents make money off real estate. So speculating on real estate is actually really easy for people to do. And that's what happened in 2006, 2007. It got really frothy, right? What was a $500,000 home a year or two ago was $1 million home. So everybody was into it. And then the bubble burst, right? So you go from break through the 80s, you have a little bit of a pullback here in 1987, recession, right? But it continues on in 91. So that's like a 4-year mini break. So it's not exactly, we've already looked at 5-year breaks over here. But that's still a secular bull market. You can see, this period sucks, but it continues to go. And then in 95, it just goes parabolic, right? Into a 13-year period. So from 2000 to 2013, the S&P 500 went sideways. So this is a period of 1980 to 2000. This is a 20-year period of a secular bull market with absolutely a big, this was a 30% down day in a single day. Black Monday was on the S&P. That was a 30%, I think something like a 30% down move in a day. Like not just a day in on the open. Like it just like boom, just crashed, straight up meltdown. And it took a few years to get out of it. And then you had another recession in 91. But then as we come out of there, we pretty much, so again, secular bull market for 20 years. And then you have another sideways market for 13 years. Okay. You have the dot-com bubble, you work your way through the dot-com bubble, and then you have the global financial crisis, which threatened to destroy the entire world's financial system, everything. And from there, the US, we've gone from 2013 to 2024 right now. So 11 years. It's actually quite not that remarkable. This bull market that began in 2009 didn't break out. You didn't get the secular bull market beginning until 11 years ago. So when we look at a secular bull market, this dip right here, this few, the commodity situation in 2000, so it was 2015 to 2016 or so, kind of a crappy period. That 2018, 2020, the 2022 recession, or not recession, bear market, it all rhymes. Okay. So in 1971, we got off the ability to back our currency with gold. And so hyperinflation kicked off, stagflation kicked off. Basically, we had hyperinflation and we had no growth in the economy. And so that's kind of what happened right there. Nothing benefiting from it. And, the gold standard coming off of it was kind of one of the issues. And that's when the Federal Reserve, Paul Volcker, realized, like, the way to do this is to just crush recession with draconian interest rates. And they came in. I mean, my dad had a 26% interest rate loan mortgage on his house during that period. It's crazy. And in 2000, the central bank started to learn more about how they can manipulate interest rates to do things. But it wasn't until 2008, 2009 that you had this new breed of central banker come in and print The printing press came. They came in with $1 trillion and bought up assets and backstopped the entire global financial system. Basically saying that all we're going to do is stimulate. Whenever there's an issue, we're going to stimulate the economy. We're going to pump money into it. And we saw that happen in there. We saw it happen a little bit. That's what ended the 2018 deal is they stopped. They were easing the balance sheet. So they were dishing assets into the market. They were flooding the market with assets, and that was causing the market to weaken. And eventually we had a crash and they recovered. And then we had the 2020 situation and it recovered through printing. And then we had the banking crisis here in March of 2023, which is not even noticeable, where they came in and they backstopped the banks like they do. They let Silicon Valley Bank die, but they backstopped everybody else and did all that. And we've just sent since then. Yeah, there was a bit of a blip. And that's the point. You have these secular bull markets that are not, they're not smooth. And if you live through this environment, it's hard to believe this over here. Okay. This, if you started trading, right in here where they were giving us a bunch of money and you bought and you bought and you suddenly realized, oh, markets go down in this area and you got like crushed in there. As this happens over here, you're still remembering this. The recency bias that we all have is to look to the previous, most recent knowledge and say, what happened? Look, I started trading right over here. Okay. This is when I started trading. The absolute high. Think about that. I started trading at the very tippity top of the stock market in 1999. It was $1,500 S&P 500 or so. And it basically never saw that again for another 13 years, right? But I'm one of the more bullish people you'll come across. I know a lot of people that started their career in here, and all they had to deal with that. So they're still only dealing with this in their mind. Their PTSD from that. I started here, and we go into the dot-com bubble and 9/11, and then rally again, and then go into global finance crash. And so the point is your opinion is one thing, but you go and look in comparisons of history, and you can see that over time, the S&P 500, especially now let me back this up here, right? Let me show when we get to the point of, let's call it right here, 1950, when we get to this point where we finally start taking off, getting into new all-time highs after the Great Depression and all that. After we get into that is when we owned the currencies of the world. We backed through our military. So all this craziness over here is kind of doesn't really have a whole lot to do with the reality of our economic system. If we need the economy to be strong, we can literally just go and borrow, because the entire world has to play the game. It's the, game theory. It's like, if you don't participate, you lose. So the only move is to participate. And we're the biggest. And we've got, a super powerful military that even if we're going to come into your country and get our butts kicked, the last thing you want us to do is to come into your country, right? It's like, look at Iraq, right? Like if we never went into Iraq, that would not have gotten the turmoil that it caused, the hell and chaos and the terror and the pain and the suffering and everything that happened was horrible. And so even though, the insurgency basically kind of won there, it was no like traditional military come in, stomp. We came in, we stomped and we won. And then, we spent 8, 10, whatever years losing. You don't want that. Even if you're like, hey, we won, you don't want your entire society destroyed. And so we kind of have that hammer, the United States, with the US dollar and our fiat currency kind of has that hammer to say like, well, we'll use our dollar or we'll come in. And so we have the BRICS. So we have a competitor with the BRICS. We have a competitor with Bitcoin, with cryptocurrencies. We have all these other potential competitors to that. But we also have, again, a U.S. military that can come in and destroy a society and lose maybe. Again, it's not a win or lose thing. It's this society is going to be destroyed. And so, okay, all that. Now, let's do some quick math. When we are, if you exclude, I'm sorry, we're including this. So if we go back and we look at the, let's just go from the breakout there to that. The S&P 500 is up 30,000% since Bretton Woods. Okay, like how far is it since global financial crisis, coming out of the top of the global financial crisis? We're up 276%. Okay. Since coming out of coming out of the gold standard. So 1971 here, right here. Since coming off the gold standard, we are 6,100% gains. So what this is it's a 12% compounded annual growth from every year on the S&P 500. Some years it's 50%, some years it's negative 10%, some years it's 3%, some years it's 20%. It averages out to 12%. Okay. So for 12%, so let's just do a simple, let's just ask Google, what is 6,000 at 12% CAGR? I'm sorry, that's not the question. How long does it take to become 6,000 to become 10 at 12% CAGR? Okay. Thought it was going to answer it for me. Let's do the CAGR calculator. Okay. 12% number of period. Well, that's not the part. I'm trying to figure out the difference. Reverse CAGR calculator. These are such a pain. Well, let's just do this. Okay, starting value 6,000, ending value 10. So yeah, it should be reverse CAGR. Here it is. Sorry, starting value 6, 1, 2, 3. CAGR 1, 2. Calculate. Okay, let's put 5. So in less than 5 years, you're at 10,000. So let's do 5,800. Let's do 12 and let's do 5 and let's see what that is. Yeah, so about 5 years is simple enough. We'll go with it. 5 years from now would be 2029 or so, 2030, give or take. So a $10,000 S&P could be conservative at 12% growth. If you say 12% CAGR, and we are only 11 years into a 20-ish plus year average secular bull market. The average secular bull market goes something like 15, 20 years. We are probably, and that could be the top. That could very well be the top. And we spend the next 10 to 15 years going sideways. I actually think that's probably somewhat close to my base case. I'm not saying that we get to 10,000 next year or this year. I'm not saying that we get there in the next couple of years. We very well could. That's the thing about these parabolic blow-offs. This 500 S&P in 1995 in 5 years tripled. I'm not even talking about a double here in 5 years. And this was that parabolic blow-off, right? That you see at the end. From 95 to 2000, 5-year parabola. So if we do a similar sort of thing, we're looking at 15,000 S&P 500 if it goes parabolic with AI, with new energy, with who knows. I don't know. But the point being is I see that as happening pretty commonly, okay? Until or unless, and I think the cycle repeats until the entire global economic system breaks for real. This could repeat for our entire lifetime, for my kids, for centuries. I'm probably betting that AI is going to change that. I'm betting that crypto probably change that. I'm betting that world wars might change that. All those sort of things are probably going to change that. We may end up with a better economic system. We may we may just completely destroy the financial system, like almost happened in 2008. Like it was pretty much like done. And the only thing they had was to print money. So what's the next tool? What's the next tool when we get to a place where we do the same stupid stuff that we have done, here, same stupid stuff we did, in here. There's a price to pay. And it could end at any given time. Now, one thing I like to do is always keep an eye. So let me bring this to a little bit more tactical before I finish up here. This is the S&P 500 futures. This is the daily chart. That was a monthly chart. This is a daily. Okay. So that secular bull market that we were looking at doesn't look this is 2013. So this is when the bull market started. That looks a lot more vicious than the previous one. But what we're going to focus on is the market regimes. So as always, I like to say, we have the, bullish, bearish, high volatile, low volatile. Bullish, bearish, neutral, high volatile, low volatile. So all of those mixed together, and you have 5 to 6 different market regimes. Since 1927, this is the distribution in each regime. So we've spent 3,000 days of 24,000 trading days. 3,000 of those days were in bull volatile, 8,000 bull quiet, and another almost 9,000 in neutral. So combined, you're looking at 20,000 plus days of 24,000 in a bull market. 246 of those days were in bear volatile. Those days are major market bottoms. If you ever see a bear volatile day, that's where you start like calling your family and saying, now's the time to buy. This is the bottom. You might be 6 months early, but it's most likely you're done with you may bang around down market for a year or something like that. But it's, the down that it's going to do after that is very, very minimal. Bear quiet has been 1/8 of all trading days since 1927. Okay, that includes the period of the Great Depression, right? That was a whole decade of the worst history. That includes the 70s, that includes the 2000s. All of that is part of this. And so 80% or so of the market's regime is in a neutral, bull quiet, or bull volatile regime. So what we want to know here is when this is green, that's bull quiet. When it's green, we are not at risk of a market top, okay, of a sell-off. And when I'm talking about a sell-off, this is a sell-off here. This was a 10% sell-off in August of 2024 that lasted, in July, peaked, took 2 weeks. We take a 10% dip and we're right back up. That is a market top, okay? But it's a short-term market top. And you see it printed blue. Also, it was just a quick print of blue, by the way. This one, the blueprint lasted for like 2 months before the market top happened. And you got it. You got your blues over here, market top. And then we were in a bear market from 2022. So all those things were not market tops. Those are just, bounces in a bear market. Market top, market tops. So what you can do, SQN is the indicator on TradingView. It's free. Go get it. What you can do here is just say when we're good in the yellows and greens, we're good for the trend. And if we get to blue, we get cautious. So you can either lighten up your position, hedge, or say, you know what, whatever, I'll deal with it. But that sort of stuff is the environment. You want to know when the environment is right to be worried and, when not to worry. Right now is a time not to worry. Okay. Very simple. Don't worry. We just go up. And this is the S&P 500. It's beating NASDAQ. NASDAQ's actually down here. So the worry, you can outsource the worry all you want, but it's chill. That could change in a couple of days really quickly. Look how quickly it went from over here. You go from, in a 2-week period, you go from chill, nice orderly trend break move to that's a top, and then crushed. So we could end up in that sort of scenario in a 1 to 2 week period really quickly. And so you would get tactical. And that's how you kind of deal with the idea that, Chris, how do you just so flippantly go through you go through life as like a perma bull like this? Well, I know that the 10-year sideways double bear markets, double secret bear market chaos, recessions and all that. I know that's coming at the end. I don't know when the end is, but historically it's about 20 years. So I feel like we've got another, 5 to 15 years to go, maybe. I could be wrong. And I will use tools like this to help me gauge that. I think as long as we stay pretty chill in this secular bull market, even with things like this happening, I believe that we're going to have a chance at that 10,000 before we do it. And if we look at the analog to 1999, this one here, if we look at that analog to 95 to 99, we could see 15,000 before we peak. If we see 15,000 before the peak, that means this game's in play. If this game's in play, this 13-year bear market, whatever recovery is in play. So I'm already expecting a 10 to 15 year recovery, double recession, whatever, to be at the end of this move. But the end of it is still a long ways away. So, all right, I'm going to put out some further research on this. I'm going to go dig in a little bit deeper. This was just me looking at charts and going through ideas and like framing it all and getting the reality in place. Like in your mind, think longer than next month, think longer than the next year. If you knew that 10,000 was inevitable in a couple of years, as long as the secular bull market stays in place, what do you do? Do you worry so much about dips, or do you look at dips as opportunities? do you look for those places to buy, right? How awesome would it have been to be buying in, any of these weak periods where the opportunity, and we've talked about, I have a tool, we have the tools to tell us when to buy during those dips. We have access to those tools. They exist. It's not super hard. You just have to open your mind to play a long-term game. Now, I day trade. Yes, I swing trade. I'm in and out of positions on a couple of week basis, right? So you may, don't think that I'm just buying the stock and then I'm going to hold it for, the 25 years or whatever, the 20 years. I missed that opportunity. But I'm here and I'm a trader. So I'm flat right now overnight. I have, of my long only portfolio, I only have about 45% exposure long right now. Over here in July, not that one. In July, I had 100% long exposure to the right here, right? From April to July, I had 100% long exposure. I went to 10% exposure here. We got short on that little dip, covered, and got long again. Okay. And I'm only long 50%. So I'm playing the long game and I am being tactical along the way. But I'm doing, if I'm going to be playing on the short side, it's quick. If I'm on the long side, it's long duration. Your down moves in a secular bull market are slow, or are very fast and direct. Your up moves are slow. So just put all that together. Again, I will be putting all this stuff together at paulinatetrading.com. Join the newsletter. You can join us in the lab. We work on this stuff all the time, /lab. The systems I use are built to trade a trending market or a mean reverting market. So you need to, there needs to be both. Like I trade the directional when we're in directional. So right, we have a side, this period from 2022 to 2023, excellent day trading, just day traded most of it all. I did end up buying some, down here towards the bottom, some long-term swings, but not much. I traded, and then, started to build long, lighten up. So that's how I do it. You want to do that stuff, come join us. Check out the site, paulinatetrading.com. I love each and every one of you. It is my pleasure to do this sort of stuff. Please comment down below. Let me know your thoughts. I'm sure there will be many.